For those of us climbing to the top of the food chain, there can be no mercy. There is but one rule: hunt or be hunted.
Have you ever seen a bond sell-off so intense that it feels like the financial world is collectively holding its breath? Well, buckle up, because the US job market just threw a curveball at the global bond market that no one saw coming. Imagine the economy as a finely tuned engine. When one gear shifts unexpectedly, the whole thing can start to sputter. And that's exactly what happened after the release of the US jobs report, sparking a massive sell-off in global bonds. It's like when you're watching a movie, and right before the big climax, the power goes out. Everyone's waiting for the lights to come back on, and we're all on edge, wondering, what's next? But unlike that movie, this isn't just a cliffhanger, it's a financial event that's shaking up markets worldwide. So, let's break it down. What does this bond sell-off mean? Why did it happen? And more importantly, what should investors be paying attention to? The US jobs report. What's the big deal? Let's start with the US jobs report that sparked all this chaos. The US economy is like the financial world's big brother. When the US sneezes, the global markets tend to catch a cold. The jobs data, which measures employment gains, is one of the most watched reports in the financial world. It's like the opening chapter of a novel that sets the tone for everything else to come. If the job numbers are strong, it signals that the economy is growing. Great news for businesses, workers, and investors alike. However, if the numbers are weaker than expected, it could signal potential economic slowdown or recession. This time, the data came in stronger than expected. The US economy added more jobs than anticipated, and that sent shockwaves through global markets, especially bonds. Why? Because when jobs numbers rise, investors start to worry about inflation and higher interest rates. More jobs mean more money circulating in the economy, which can lead to increased demand for goods and services. And what happens when demand increases? Prices tend to go up, which means inflation. Now, inflation isn't a bad thing in small doses. But when it spirals out of control, central banks like the Federal Reserve have to step in and raise interest rates to keep it in check. And that's the moment when bond investors start getting nervous. Because as interest rates rise, the value of existing bonds goes down. You see, bond yields and prices have an inverse relationship. If rates go up, bond prices drop. It's like a seesaw, and suddenly the bonds are on the lower end, dropping like a rock. The global impact, a domino effect. So, what happens when the US sneezes and bond prices start plummeting? The whole global market starts to shake. Think of the bond market as a giant web. Each country's bonds are tied to each other in a complex network. When one part of the web weakens, the rest feels the strain. European bonds, Asian bonds, everyone gets caught up in the sell-off. Let's take a closer look at how this works. Central banks around the world closely monitor US economic data because the US dollar is the world's reserve currency. If the US economy is growing and inflation is rising, it can lead to tighter financial conditions globally. For example, if the Federal Reserve raises rates, it could signal that other central banks might do the same, which increases the cost of borrowing everywhere. So, as US bonds take a hit, investors start unloading bonds in other markets, fearing a global ripple effect. But here's where things get interesting. As bonds start to lose value, there's a shift in the market. Investors who have been holding bonds in anticipation of low interest rates for the foreseeable future are suddenly faced with the reality of higher borrowing costs. It's like finding out that the free lunch you were promised is actually a 5-course meal that comes with a hefty price tag. Now, in times of bond sell-offs, investors typically turn to safer assets, like gold or cash. But guess what? Even gold wasn't immune to the turbulence in the market. The real question now becomes, how long will this sell-off last, and how will it affect different regions of the world? Inflation and interest rates, the dynamic duo. Let's talk about inflation for a second, because that's the main driver behind this bond sell-off. Inflation isn't just a financial buzzword. It's a force that can make or break economies. When inflation rises, central banks have to make a decision. Do they let it run its course, or do they raise interest rates to cool things down? Right now, inflation is running hot, not just in the US. In Europe, inflation has been stubbornly high, and in emerging markets, central banks are having to tighten monetary policy just to keep up. For bond investors, this is a tricky situation. Rising inflation means that the real value of bonds is eroded. If you're holding a 10-year bond that promises a 3% return, but inflation is running at 4%, your real return is negative. To combat inflation, central banks usually raise interest rates. This is where things get really interesting. Higher interest rates make borrowing more expensive, which can slow down consumer spending, business investment, and overall economic growth. But for bondholders, higher rates are a double-edged sword. While new bonds might offer higher returns, the value of existing bonds with lower yields drops. This is why the US jobs data is such a crucial piece of the puzzle. Strong job growth indicates a stronger economy, which could lead the Federal Reserve to hike interest rates more aggressively. And that's what sends the bond market into a tizzy. Investors have to decide whether they want to sell off their bonds before prices drop further or hold on and hope for a rebound. But with inflation being what it is, holding on to bonds could feel like watching your money slowly melt away. The role of the Federal Reserve. If you've been following the US economy over the past few years, you're probably familiar with the Federal Reserve and its role in managing the economy. The Federal Reserve controls interest rates, and it uses them as a tool to manage inflation and promote economic stability. When the economy is growing too fast and inflation is getting out of control, the Fed raises interest rates to slow things down. When the economy is sluggish and unemployment is high, the Fed lowers rates to encourage spending and investment. Right now, the Federal Reserve is in a tough spot. They have to balance strong economic growth with the need to keep inflation under control.